Chapter 9, Accounting for Receivables. Receivables are assets that normally represent future cash collections. Amounts due from customers from the sale of goods or services provided are accounts receivable. Formal documents, usually containing interest, are notes receivable. Non-trade receivables that includes amounts due from officers, employees, and income taxes refundable are other receivables. Accounts receivable are presented in the balance sheet in the current assets section. The amounts that a company estimates it will not collect from its customers are recorded in the contra asset account titled Allowance for Doubtful Accounts. The amount from the allowance for doubtful accounts is subtracted from accounts receivable to determine the net realizable amount. So of the $500 gross amount of accounts receivable, the company expects to ultimately collect $475. There are two methods of accounting for uncollectible accounts. The direct write-off method is theoretically undesirable because there is no matching of revenues with the bad debt expense. The direct write-off method does not record bad debt expense until specific customer accounts are identified as uncollectible, perhaps due to the customer's bankruptcy. To illustrate, a sale on account could have been made in October 2010, but after 6 months of attempting to collect from the customer, it is determined that collection will not occur, and the company records bad debt expense in April 2011. Under the direct write-off method, the revenue, sales, is recorded in 2010, but the related bad debt expense is recorded in 2011. Because the allowance for doubtful accounts is not used in the direct write-off method, the receivable is not stated at net realizable value. If accounts receivable are material or significant, the direct write-off method is not acceptable for financial reporting. Let's contrast the allowance method. Losses related to uncollectible accounts are estimated because the company does not know which specific customers it will not collect from in the future. Because bad debt expense is estimated, there is better matching of the revenue with the related bad debt expense. The receivables are stated at net realizable value because the allowance for doubtful accounts is subtracted from receivables. The allowance method is required by GAAP, generally accepted accounting principles. The journal entries related to valuing accounts receivable are presented here. To record estimated uncollectible accounts, the adjusting entry that is prepared at the end of the accounting period is debit bad debt expense and credit allowance for doubtful accounts. Remember that allowance for doubtful accounts is a contra asset account, therefore it is credited. To write off specific uncollectible customer accounts, the allowance for doubtful accounts is debited and the accounts receivable is credited. Because the company does not expect to collect the amount due from the customer, it is necessary to remove or credit the accounts receivable. If, after writing off the customer account, the company does end up collecting the amount due from the customer, there are two journal entries that are recorded. The first journal entry necessary is to put the customer back onto accounts receivable. The journal entry that wrote off the customer is reversed. Accounts receivable is debited and allowance for doubtful accounts is credited. The second journal entry records the payment. Cash is debited and accounts receivable is credited. There are two different bases used for the allowance method. The first is the percentage of sales. The estimated uncollectible amount is based on sales. and therefore because sales are recorded on the income statement, the emphasis is on income statement relationships. In contrast, the percentage of receivables method estimates the uncollectible amounts by examining the accounts receivable. Because accounts receivable appear on the balance sheet, the emphasis is on balance sheet relationships. To illustrate the percentage of sales, Gonzalez Company estimates 1% of net credit sales will become uncollectible. Net credit sales of $800,000 are determined by subtracting the contra revenue accounts, sales returns and allowances of $35,000 and sales discounts of $5,000 from credit sales of $840,000. The journal entry estimating the uncollectible amount is debit bad debt expense for $8,000, calculated by multiplying net credit sales of $800,000 by the 1% uncollectible. The credit is to the contra asset account, allowance for doubtful accounts. The percentage of sales method emphasizes the matching of expenses with revenues. The existing balance of the allowance for doubtful accounts does not come into play for determining the amount of the journal entry under this method. Posting the journal entries to the T accounts results in the debit balance of $8,000 in the bad debt expense account. The January 1 balance in the contra asset account, allowance for doubtful accounts, is the expected credit balance. Posting the estimated uncollectible amount of $8,000 results in an ending credit balance of $9,723. This aging schedule of accounts receivable is used to determine the adjusting entry for accounts receivable using the percentage of receivables method. The total of accounts receivable is $39,600. The accounts receivable will be categorized by aging, not yet due, and the number of days past due from 1 to 30 days up to over 90 days past due. The total accounts receivable not yet due is $27,000. 1 to 30 days past due is $5,700. 31 to 60 days past due, $3,000. 61 to 90 days past due, $2,000. And over 90 days past due, $1,900. These amounts add up to total accounts receivable of $39,600. To determine estimated bad debts, an estimated percentage uncollectible is multiplied by the accounts receivable. This company estimates 2% of its accounts receivable not yet due will become uncollectible. The estimated bad debt associated with the accounts receivable not yet due is $540, calculated by multiplying accounts receivable of $27,000 by the 2%. The company estimates it will not collect 40% of its 1,900 accounts receivable that are over 90 days past due, resulting in 760 estimated bad debt. The total estimated bad debt is calculated by totaling each aging category of estimated bad debt, resulting in 2,228 of total estimated bad debt. The amount of 2,228 is the desired ending balance of the allowance for doubtful accounts. The trial balance shows the allowance for doubtful accounts has a credit balance of $528. The adjusting entry to record estimated bad debt is debit bad debt expense and credit allowance for doubtful accounts. To determine the amount of the entry, the credit balance of $528 is entered into the credit side of the allowance for doubtful accounts. Because the desired ending balance is 2,228, as determined on the previous slide, the amount for the adjusting entry of $1,700 is calculated by 2,228 desired ending balance less the existing credit balance of $528. After posting the adjusting entry, the ending balance is $2,228. Note, if the balance of the allowance for doubtful accounts before adjustment was 528 debit balance, the adjusting amount would be determined by adding instead of subtracting the 528 to the 2,228. Notes receivable are written promises